So we published our investment outlook at the very start of September, and we were looking for, we advised more resilient portfolio construction, because we are looking at the mid-cycle stage of the economic cycle, and then obviously, we are still looking at a very low interest rate environment, but the start of tapering from November. So what that means for us is slower economic upside means somewhat slower upside for equity markets as well, but still up. So therefore, we remain invested. But more volatility as this Fed tries to negotiate that turn in policy, and obviously there is execution risk around that. And there's also uncertainty around the impact of the Delta variant and headline risk around the world. So what we've done is, indeed remaining invested in equities, in high yields, and in emerging markets, but looking more for quality across the board, large caps, and also income, of course, and obviously global diversification, to try to make that performance more steady, because we are looking for somewhat more vol.
Yeah, in your notes, you mentioned that you see the world economy now moving towards the mid-cycle stage of growth. How does that square up with the price action we've witnessed in the US dollar over the last couple of sessions? It seems to be going from strength to strength, and that would only happen in an environment where people were actually getting very concerned and looking through the mid-cycle stage towards perhaps a lower growth or even a stagflation sort of environment. So how do you see the dollar squaring up with your worldview right now?
So the scenario you paint obviously is a positive for the US dollar. I'm not sure that we are in that scenario. I think the reason why we're looking for US dollar strength and why we're seeing it is that there is a somewhat slower growth around the world. So the upward pressure on other currencies that you had during the recovery stage, is behind us. And then secondly, to a large extent, it's the interest rate differential. Where obviously you've now seen, especially the latest upward move in the US dollar was related to that real yield, and that real yield move in our view is concerned to the market, is linked to the market's concern around tapering. Again, we think that the Fed is communicating this very well. That the market shouldn't really be that surprised. So we can't really see that real yield move much further. But with global equity markets slightly less bullish, global growth slightly less bullish, and the interest rate differential, we still see slight upside for the US dollar against euro and against sterling.